to the daily insights that matter. We begin today's DITM by looking at the August GST collections, which have spiked 28% year on year. However, they have sequentially declined when compared to the July GST collections. India collected 1,43,612 crores in goods and services tax in August 2022, registering an increase of 28% from the mop-up a year ago. However, when compared to the tax collected in July, the August GST mop-up was 4% lower. As seen in the chart, this is the 7th time that the monthly GST collections have crossed the 1.40 lakh crore mark since the inception of GST, and August is also the 6th month in a row since March 2022 for the GST collections to have crossed the 1.4 lakh crore mark. E-way bills, which are used in interstate transactions, also showed a pickup. During July 2022, 7.6 crore e-way bills were generated, which was marginally higher than the 7.4 crore bills generated in June and 19% higher than the 6.4 crore bills generated in July 2021. Record GST collections were seen month over month as a result of the tax reform measures. Record GST collections reflect the strength of the underlying economic factors, demonstrating not only an improvement in economic activity but also the effectiveness of the measures to plug revenue leaks. We expect the trend to continue through FY23, giving the Union government a budgetary cushion to manage the fiscal deficit. Now, with the onset of the festive season, the collection in the forthcoming months will continue to remain robust and may well exceed the budgetary targets set for this fiscal year. While the GST collections remain robust, let's look at another metric which continues to remain strong. India's manufacturing sector continued to grow in August due to robust demand and easing inflation concerns. PMIs are indicators that point in the direction of future activity in the manufacturing sector. They are made up of various sub-indices, including those for output, fresh orders, export orders, unemployment, sentiment, etc. In terms of the PMI, a reading above 50 indicates expansion and a reading below 50 indicates contraction. S&P Global India Manufacturing Purchase Managers Index, or PMI as we know it, reported a reading of 56.2 in August 2022, decreasing marginally from July 2022's reading of 56.4. The output growth rose to a 9-month high on the back of sustained improvement in the demand conditions boosted by new order intakes. Factory orders rose at the quickest pace since last November. Business sentiment also strengthened from the June, which was a 27-month low number. A fourth consecutive monthly reduction in the rate of input cost inflation, which fell to the lowest level in a year amid reduced pressures from the commodity prices, provided additional support to this strong performance. India's manufacturing activity was also the strongest in Asia. For China, Japan, South Korea, Taiwan, Malaysia, the manufacturing PMI actually decreased in August. There was also a contraction in the manufacturing activity in Taiwan, South Korea, China, and Malaysia specifically. The PMI data pointed to an improvement in the overall operating conditions for the 14th straight month, while also remaining the strongest in Asia. Overall, August PMI also pointed to the second strongest improvement in operating conditions since last November and also showed that the impact of inflation was really coming down. India's auto components sector saw higher exports than imports in FY 2022, resulting in a trade surplus of approximately $700 million for the first time ever. Let's understand how this happened and whether the trend could be sustained going forward. India's auto ancillary industry majorly supplies to the OEMs, or the original equipment manufacturers in the auto industry. 2/3 of the exports are directed to Europe and North America. As consumer demand spiked post the aftermath of COVID, auto companies ramped up production, and hence the demand for auto components saw a spike across all segments. Additionally, more and more manufacturers started to look for diversification options outside of China for their supply needs to reduce their dependence on a single country. India turned out to be the favorable low-cost alternative for most of the large auto manufacturers. Hence, the exports in FY 2022 grew by 42.9% to $19 billion, exceeding imports by approximately $700 million. While the imports also grew by 33% in FY 2022, the exports grew faster, resulting in a trade surplus from the auto components. So should this be considered as a one-off case, or is this trend sustainable? Now, with the growth seen in FY 2022, Indian manufacturers are continuously exploring opportunities to localize the supply chain by bringing in higher vertical integration and ramping up the production of value-added products at home. Additionally, according to Automotive Components Manufacturers Association, or ACMA as it's well known, the surplus has continued well into the first quarter of FY 23. While there were fears that the geopolitical crisis would impact the supply chain and create bottlenecks, this has not been the case yet, as the shipments to the European markets continue at a healthy pace. That said, the continuous emphasis on localization, the government's push to add more domestic capacity by providing incentives under the PLI scheme, a healthy demand for automobiles, and the emergence of new automotive segments in the EVs are all factors which the industry experts believe will help the exports increase imports in FY23 as well. A report by IBF also stated that the exports are expected to grow at an annual rate of approximately 23% and will hit the $80 billion mark by 2026. So what does all of this mean for you? Higher GST collections is testimony to the strong economic revival as a result of a recent uptick in the industrial and business activity. This shows that the Indian economy is well on track. This will have an indirect positive impact on you. The improvement in manufacturing PMI numbers for the 14th straight month points to a strong momentum in the manufacturing outlook for the country. This will have an indirect positive impact on you. The China Plus One policy may not have resulted in an outpour of investments into India directly, but the increase in the order book and the resultant growth in the exports of automotive components is testimony to the fact that India is indeed a favored, low-cost alternative for large auto manufacturers globally. This will have an indirect positive impact on you as well. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.